Okay, so for today's video, we'll be doing a quick run through of how to determine breakouts in the market using two indicators specifically, being the Bollinger Bands as well as the RSI indicator as a filter. So to start things off, under trend, we find the Bollinger Bands, and just got to change the color here. Just reset the settings to the original, and we've added the Bollinger Bands. So just to explain what Bollinger Bands do is it's an indicator that measures volatility. Okay, and the strategy can be applied to any time frame. Okay, and how this indicator particularly works is when you have the top band and this bottom band wide apart, where the distance between them is spaced out, this basically means the market is very, very volatile. And for this strategy, we ignore the middle line of the Bollinger Band. Okay, and what we're basically looking for over here, since we now know that when the Bollinger Bands are wide apart, the market's volatile. So we tend to look for areas in the market where, you just zoom in over here, okay, we're looking for an area in the market, like in the bottom left section over here, where basically you can see that the space between the top band and the bottom band is very, very close to each other, okay. Some people refer to this in the market as a market squeeze, okay, where these two, the top and the bottom, are squeezing close to each other, right? And from here, what this lets us know is that the market is consolidating and pretty much moving sideways. The market is looking for direction, whether to continue higher or lower, okay? And in this case, you can see the market has continued higher. And as soon as the market breaks out, okay, you can see that the distance between the top band and the bottom band starts to widen apart, okay? So the whole concept is, once we have the setup where we have a market squeeze, we're looking to take advantage of the next leg up, okay? So the first rule of the strategy is identifying the squeeze, which we have done over here, all right? Then the second part of the strategy, which would be the signal, is we're looking for a candle to close either outside the bottom band, okay, which would be bearish, or close outside the top band, which would be bullish. So looking down here, this candle poked outside the bottom band, but however didn't close outside the band. Same as this candle. At some point, it went outside the bottom band, but when the candle actually closed, it closed outside the top band. So I'm just going to mark out this particular area here, okay? On that candle, we can see it's closed outside the top band. So step one, look for a squeeze. Step two, we're looking for a candle to close either to the upside or to the downside, using the top band or the bottom band. So that's step two. Once that happens, we then need an additional indicator. For this, we're going to use an indicator known as the RSI, okay, known as the Relative Strength Index. So just going to apply this indicator, okay. So this is the RSI at the bottom in blue. Now the RSI, Relative Strength Index, it basically what it does is measures the strength of the trend, okay. And how it's commonly used is that when price hits the 70 level, people tend to say that an asset is overbought, okay? And when it hits the 30, that it's oversold. So when a market, for in particular from this area, it's hit the 70 line, so most market participants would then be looking to sell, saying the assets overbought, it's hit the ceiling, it's time to sell. And when it hits the bottom, it's overbought, it's time to buy. Now, through time, I've had to edit through a lot of back testing the strategy, and you find what's commonly taught doesn't work. Reason being, from this area here where RSI was overbought, you'll see that it remained overbought for quite some time, since we're on a daily chart in this example. So for quite a number of days, the RSI remained overbought, meaning a lot of participants would be looking to short this asset. However, the price just went higher and higher and higher, and you'd be in a position where you're then losing a lot of pips for as long as you hold the trade. So in order to avoid being caught out by that, because what this tends to lead to is the classic saying, markets can remain irrational, hence this blue line being overbought, longer than you or I can remain solvent, meaning the account's still breathing. So in addition to this, what we then do is we just right click on the RSI and we go to the levels, and we're basically going to edit the levels. We're going to change the 30, which is this bottom line, to 45. And we're going to change the line that's 70 to 55, okay? And we're going to say okay. And now you can see the two lines over there. Now, the reason we do this, to give a simple layman's example, is 50 is basically the halfway line. So how we take this is that since 50 is the halfway line, as if we're playing a game of football, once the RSI is over and above 50, you basically now attacking, or you know that since the RSI measures the strength of the trend, if it's above 55, we know that it's got a lot of strength for the upside. And vice versa, once the RSI is below 45, it's past the 50, which is the middle ground. So once it's below 45, we know that, okay, there's a lot of strength and momentum to the downside. So we use that concept as a filter instead of the traditional 70 and 30, where the market can remain overbought. Okay, so now putting these two things together, the Bollinger Bands measure volatility, all right? So when the bands, the bottom band and the top band, are wide apart, we know the market's very volatile. So in terms of our setup, we're looking for a squeeze where the top band and the bottom band are very close to each other. So squeeze, that's our setup. That's the first rule. Second rule, we focus on the candle. If a candle closes below the bottom line, it's signaling that that's a potential bearish move. If it closes above the top band, it's signaling a bullish move. So we've had the squeeze, number one. Number two, the candle has closed outside the top Bollinger Band line. So rule number three, the confirmation is what we could call it, to confirm what is the momentum and what is the strength behind this breakout. We then refer to the RSI, and you'll see following the red line, directly in line with this candle that's broken out, the RSI happened to be above 55, okay? So that's our confirmation. We now know that The market was confused, moving sideways, which caused the squeeze or the confusion, which was number one. Number two, we've broken and closed outside, signaling a breakout. And number three, the RSI is above 55, which confirms strength and momentum in that direction. Okay, so once we've done number three, the fourth step is then to enter the trade. And the entry rule is you enter at the open of the very next candle, which would be this candle over here, the very next candle. And once you enter on that candle, we then looking obviously to exit the trade. So in terms of exiting, the rule is you count 5 candles from the candle you've entered on. So 1 is the squeeze, 2, the candle has closed and broken outside, 3, signaling a bullish breakout, meaning prices should go higher, 3, the RSI is above 55, so we know we've got momentum and a lot of strength behind this move that's about to begin. 4, we enter the very next candle, and 5, we count 5 candles starting from the candle we've entered. So this candle we've entered on would be candle 1, this would be candle 2, this would be candle 3, this would be candle 4, and that would be candle 5. So in this case scenario, this is where we would can't see that color. So 1, 2, 3, 4, 5. So this is where we would exit the trade. So from the base all the way that's up to there. In this case, you can see the dollar yen happened to move rounded off 325 pips in this particular move over a period of 5 days. Okay. Another factor to point out, the reason we get out after 5 candles is there's a common rule in the market which says you very seldomly get candles that are the same color where you'll get more than 8 candles. So even starting from down here, this candle was bullish, this candle is bullish, this candle is bullish, this candle is bullish, this candle is bullish. So we only got 5 in this instance. So very seldom will you get a 6th, 7th, or 8th candle that's the same color. It's just market probability where this stems from. So again, from entry, it would be 1, 2, 3, 4, 5. Okay, so I'm just going to change the time frame, and we're going to try find another example. Maybe let's just change the pair we're looking to trade. So we've thrown on the Aussie dollar versus the US dollar, and we're on a 1 hour time frame. So again, looking at this, you can see again over here, we've got an area in the market where the bands are squeezing close to each other, letting us know that the market is confused or there's uncertainty. So number 1, we've got the squeeze. Number 2, this candle has broken the bottom band, signaling to us that there's a potential of a bearish move, okay, giving us direction. And the third thing we then do is directly where this candle breaks out, we then want to see the RSI. Is it below 45 in the case of a bearish trade? And as you can see, the RSI was below 45. So we've had the squeeze, we've had a breakout and a close below the bottom band. The RSI is below 45, telling us there's strength and momentum behind the trade. So rule number 4, we enter on the very next candle, placing a short trade, okay? And from that candle that we enter on, we then count again up to 5 for exit. So this candle would be 1, 2, 3, 4, 5. So just to measure it out again, would enter at the base here. So initially we went out the money, then 2, 3, 4, 5, back into the money. So in this case, 16 pips in a space of about 5 hours. So obviously, the bigger the time frames, the bigger the pip count we targeting. The smaller the time frame, the market can only move so much over a certain time frame. Here's another example here where we've had a squeeze and the market's pretty much moving sideways. Okay, and as you can see, this candle over here, we have added this vertical line, has again closed outside the top band, which is a bullish signal. We then look back down, RSI is above 55, which is rule number 3, giving us confirmation that we've got a lot of momentum and strength behind this new move that's about to happen from this breakout. Rule number 4, we enter on the next candle, count 1 from that candle, 1, 2, 3, 4, 5. So again, to give a quick count, 1, 2, 3, 4, 5 would get out at the close of the candle. So in this case, we netted 31 pips. So repeat it, or to do one more example. Again, this area over here, we had a slight squeeze. Okay. That candle over here closed outside, RSI below 45. We enter on the next candle. So it's 1, 2, 3, 4, 5. Okay, so we would enter at the base of the candle. So it initially went our way on the first candle. We're out the money on the second candle, third candle, fourth candle, try to correct, and boom, on the fifth candle, we're down here for roughly 25 pips. Okay, and this is the breakout strategy using the Bollinger Bands, where we're looking for areas with a squeeze. Okay, then followed by a candle breakout where the candle closes, breaks and closes outside either the bottom band or the top band of the Bollinger Bands. We then confirm it with the RSI. If it closes above, we want RSI above 55. If it closes below, we want the RSI below 45. Then rule 4 and 5 is enter on the next candle. And from that candle, count 1, 2, 3, 4, 5, get out the market. From that candle, enter on the next one, 1, 2, 3, 4, 5, out the market.